they keep making the stock value of the people in the 10 people in the small room getting all the salmon and the lobster, super rich. So any innovation that challenges them can be bought out cheaply with a hyper-valued equity, whilst the rest, the S&P 500 is flat outside the top 10. That's where you're at. Never seen so many reval videos. Listen, if you had someone on who was talking about reval, it's no bad on you. If it's topical and has been spoken about, have it. But I'm kind of the anti-reval guys. They're not going to blow up the banks. All the derivative markets, by doing a 4 or 5x on the money just to open up overdraft that they'll end up consuming and then need to do again. They can't do it. Currently a guy called Loeb, L-O-E-B, who is putting it out there that there is something with a trajectory in outer space hurtling towards our planet, and that it seems to be very well directed, which may imply alien control. So this is, for me, is absolute fantasia. It has a bigger stink than the original story of 19 about it. It spells psyop by the person, by the university, and by everything else. And that is something that requires an entire planet to respond. Remember, they want to crush. The global communists wish to crush nation-state boundaries.
You're watching Capital Calls. My name is Danny. It is August 14th, 2025, and my guest today is none other than the market sniper himself. It's Francis Hunt.
Glad to be back with you, Danny, as ever.
It's always a pleasure, Francis. You and I are going at it here for just before the camera hit record. But let's go ahead and dive into what's on your mind lately, Francis. We've got some interesting news coming out of the government as it relates to both retail inflation, the CPI, the Consumer Price Index, as well as wholesale prices as well. Are we seeing inflation come back? Is inflation gone? What's your take on this?
You know me as that guy who talks about hyperstagflation, which is stubbornly high inflation and an incredible degree of economic stagnation. So we had the Goldilocks economy under Greenspan when we globalized, and they said no inflation because in core commodities there was no inflation. All your clothing, your shoes got sent out to Bangladesh to be made by 14-year-old kids and China, etc., at incredibly low wages. And we said no inflation. Meanwhile, the stock market inflated, every asset's inflated, housing inflated. That's the beginning of inflation. Inflation actually is money issuance, and it's driven also by government over expenditure. And in that Goldilocks period, we had government over expenditure without consequence because we had a bond market that still inched up in capital values, even though the yield went down. So actually people were making money being long bonds for 40 years that they're no longer making now since 2020 in September when we called that. So what's happening now is we've just had a PPI number come in, Danny, and everybody's expecting 0.2 month on month, and it's just blown out at 0.9. That's not a small miss. Everybody thinks we're talking about noughts. No, annualized 0.9, you end at 10.8%. That is production price index. And everyone was saying, you see, we're going to get a cut after the CPI, the consumer's inflation, that has been going on in the previous release earlier on in the week. So they say almost certain a rate cut. And we've continued, we've shown up with you. We said it's hyperstagflation, it is debt debasement, and rate cuts are going to be few and far between and very short of duration. And you're going to be higher for longer, regardless of how not strong the consumer is. So the CPI being not out there, everybody thinks we are safe. But the problem is the producer price inflation has shot ridiculously, almost 11% on an annualized basis, which is double digits territory. What that probably says is that manufacturers have been absorbing cost on margin to not blow out on the consumer prices. So they've stuck with their original pricing whilst their costs have consistently worked up. That means margin compression. And they weren't in supernormal profits anyway, because we haven't been that strong in the economy for quite a while. As we also mentioned, in 22, we met the criteria for a recession, and we suddenly got a new definition that hung on data about employment that later turned out to be a lie. So we did a cycle around video where we said all stats are lies. The non-farm payroll number is a lie. We've continued to call it fake number day. And we've continued to highlight that it's within government's interest not to represent the truth about where we truly are, which is the whole raison d'etre for coming on your program and actually talking about what we feel is really the truth. And that is number of jobs created is a lie. Unemployment rate is a lie. It's far worse in both instances. And here, on terms of inflation, it's a lie, which John Williams and many other people have also worked on. Even Peter Schiff is on the money a lot on all of this. And what we've just had happen is the future CPI is going to grow because manufacturers don't do the not-for-profit trade. They're not like gold and or silver slammers late on a Friday afternoon selling 20% of silver supply at any level, and the further down it goes, the happier they are. They aren't those kind of traders with bottomless pockets that want to lose money. So you're going to see a groundswell of prices rising on the consumer as a result of this PPI number. The corporations that are selling goods and having increased costs cannot continue to function at the current retail prices. That's what this data tells you. That says inflation. That could have knocked back the possibility of that September rate cut really, really far back. And it's always, and funny enough, I just retweeted the meme with the donkey and the carrot, with the rate cut Fed, and the donkey keeps chasing. It's like the cut that never comes. And always just before, when it's a dang certainty, there comes some number that goes and blows out. So occasionally they might almost be semi-truthful because, as I've said before, and other YouTube channels have got this wrong, it's not, no, the Fed doesn't understand how all the signals, as some YouTubers are saying, about how bad the economy is, they're going to be late again and all of this. It's the debt market, stupid. People aren't going to pay a higher price for a lower yield on an instrument that's being absolutely proliferated. And you and I were talking about the M2 and the proliferation. And that is new money. We went over the categories together about where it comes from. If M2 is coming out, let's just recap and then I'll pass back to you. Bank lending is climbing. Central bank policies, there might be open market operations. They lowering reserve requirements for banks. We know that happened. Hey, don't worry about balance sheet. Just keep lending. You don't have to worry. Keep lending and quantitative easing. Now, officially, we aren't doing any quantitative easing. Then there's government spending increases, M2. Well, they've just given the military industrial complex a few $100 billion. They've been giving contracts out to Palantir that's seen that stock price double this year. And we know all the other status ones that they keep on the going. And then interest accrual, interest earned on saving accounts, some people will say, or like money market accounts or CDs, are also part of increasing M2. Who's earning all the interest? The cartel that was given the exorbitant privilege of being the ones that borrowed your money, borrowed into existence when it could have just been issued into existence. They are receiving the interest. It's the biggest payment that the government is paying. It's surpassed the military industrial complex. So that is also extra wealth to the legacy families that they're just hoovering up. So M2 up, inflation up. It's invariable, it's mathematics. It's almost the definition of inflation.
Yeah. Well, that's even if you believe the CPI to begin with. I mean, as you and I well know, there's concepts like hedonic adjustment, substitution. So even if the CPI was wrong, I mean, why are we suddenly to believe government statistics all of a sudden? If you look at like shadow stats, for example, it's usually about 2x the CPI number. And so
I'm pretty sure, I haven't got a current subscription, but he's spot on generally, and I'm pretty sure you're in double digits zone at the moment. And more importantly, that I'll just bolt on the back end of that, it's in a recessionary environment that you're in double digits, which is why, as we say, hyper stagflation, we're stagnating the consumer. There's a two-tier economy, as you know. There's probably a two-tier judicial system. There's a two-tier everything as far as I can see. But there is a real stagnation for the consumer because we've got crowding out. The person with all the money is government that's borrowed it into existence. The people doing all the big spending is government, and it's going to a corporate fascist cartel that are building our future surveillance finance world for them with servers, AI, robotics, and everything else. And the consumer economy, our economy, small business lending is not up, but small businesses hire way more than the S&P 500. S&P 500 is only 18% of the employment. Yet in terms of crowding out of capital, and this is a really important point, Danny, 40% of the market cap and the capital is invested in the top 10 companies. The rest of the S&P 500, 490 other businesses are only 60%. Now you say only 60% is the majority. I'm comparing 10 to nearly 500. That's how much capital is crowded out into those places, and government contracts keeps ramming it into the room where there's 10 people. Imagine you had to feed 500 people and all the buffets kept going into the room where just the 10 of us were sitting. You would say there's a two-tier capital system with bottlenecks for small businesses, restaurateurs that might want to open a second store that will have to sign their life away and admit and agree to untold usury extraction versus multi-billions loaned on the cheap to megacorps that are actually building what we absolutely never voted for. So that's another point to throw in here. And finally, ETFs that actually keep pushing the valuations of the 10 people in that room up because everybody's decided we don't want a managed portfolio. It's cheaper in ETF. We give our money to BlackRock. They scoop up all the voting proxies to pursue transgender type agendas and everything else, ESG, and every other bent Marxist cultural subversion. And they keep making the stock value of the people in the 10 people in the small room getting all the salmon and the lobster, super, super rich. So any innovation that challenges them can be bought out cheaply with a hyper-valued equity, whilst the rest, the S&P 500 is flat outside the top 10. That's where you're at. So it's an interesting summation of how capital is allocated as well.
Yeah, and just one final thing to put a cherry on top. This is M2 yearly growth versus inflation. You've got inflation here in black. I'm sorry. You've got M2 growth in black, and then you've got inflation in red. And you can see there's a very strong correlation between the two. I mean, obviously, because that was the classic definition of inflation. Now we have all these other definitions of inflation. But if you are indeed to use the classic definition of inflation, you will notice that we saw a pretty rapid spike down on yearly growth on M2 money supply, but we've recovered quite a bit. We saw a spike back up. However, the CPI has not, in conjunction, moved back up in tandem with this recent growth in M2 money supply.
Can you zoom in on the most recent last 5 years? Because it's an interesting chart, and I think everyone will value that, particularly if we can just get the COVID dip low and events there. You see, that's the big volatility that was causing it. We had the COVID jump in, and then the inflation understandably followed. They claim it topped out at 10%. I would have that red line virtually as high as the black line in terms of true inflation rate, at least part the way up, a lot higher than they've put it. But they kept it technically under double digits there, and they crashed the M2 chronically. And that's when we started to get these recessionary numbers that they denied. And now they're reflating. They are reflating, not at the rate of CV19 like they did. You can see that kick up when you went nearly vertical just in the 2020 year. That was March to the left. Yeah, that one. That's the bit that definitely brought the inflation. Then they kept adding slightly after that. And then they needed to take the fruit bowl away a little bit because they'd spiked it a bit too big on the punch and all the other accelerants. So, yeah, that's the story. And they're back to doing it now. And it wouldn't shock me, by the way, if you're getting liar statistics and they try, this is a masking agent of intent for me in terms of overstating non-farm payroll recruitment numbers. Stop me if I've mentioned this, but we had 2 revisions in May and June. They were 133 and 125,000 jobs. So that's just directly after that, they've taken that amount of jobs out. Last year, they then do an annual revisit the numbers and a second haircut. Last year, they took 819,000 jobs after the monthly revisions. And that averages at another 73,000 out. So the average is about 58, but the last 2 revisions was 125 and 133. So the average of the revisions is going ever higher. Yeah. So you're reaching a point, if you take the 133 and the fact that at the end of the year, they take another 70,000 a month off if they're taking 800,000 a year, you probably need 200,000 job created on the numbers to not actually be contracting. That's how fraudulent the number is. So it's complete insanity. And I actually see Trump got a new BLS head. Remember, he was firing the Biden woman who was making him look bad, a little bit of political theater and all of that. And that guy's now saying, well, given how unreliable the numbers are, so now they're calling it fake number. We've been calling it fake number for 10 years. Now they're actually suggesting that it's deeply inaccurate and that they don't want to give you data on a monthly basis anymore. They'd rather wait for a quarter end so that they have to lie less often and they get less anomalies. They're thinking, and some guys, and I see the response of some people, they're going, yes, I'd rather they did that rather than giving us dodgy numbers and gave us a better number after a quarter. What's wrong with that? No, they're taking the pressure off themselves, lying 3 times to only have to tell a lie once and doing a bit of smoothing and manipulation. This is news and statistics management, and it's a masking agent to hide the fact that you're in hyper-stagflationary times. There is, in real terms, a contraction going on. Cost of living is rampant. I refer back to the 134% increase in 5 years on the same Walmart checkout bill that I've been talking about that a lady did. She put the exact same items that she had 5 years ago during CV19, and it's 138% up. That's 2.4 times, basically. If you paid $100, it's costing you $240 today. So that's the inflation is at a parabola. By the way, the whole gold reval guys that got all excited, the only thing that's really interesting to me is at $42.22 in 54 years ago, that's 8.4% dollar devaluation on average over the duration, which is also now in a parabola, in my opinion. And the last 5 years, and certainly from subprime as well, has probably brought that number up considerably. So you're probably running at a far higher level at that point as well. So let me hand back on statistics. Don't believe anything from government in a statistical space. It's all managed news flow.
Well, let's go back and look at the markets then. This is the 10-year yield. Let me know if, okay, here it is. This is the 10-year yield, and you can see it's been consolidating for a number of years now. Where's this thing going here, Francis? Looks like it's consolidating. It's about to break out. I would say to the upside, but your take?
Yes. In fact, Danny, I'm going to ask, because yours was not so easy to see, if you'll allow me, and I'll show the exact same chart, because the white background just pops a little better for the viewers. And if I just request the share screen, and we'll go entire screen, there we go. So if we do that, and I get that 10-year up that you were talking about, that's Heckler Mining. That's not what I wanted to show you. There's the 10-year. So you can see that pop on the 10-year. It was coming off. That's on an hour. Let's just take you back out a little bit. That's the monthly. Let's remind everybody, this is the turn and the turn of a 40-year turn. This is an upside squeezer for a break to the upside for us. Has been, always has been, and we continue to expect it. And it's not a reversal. It's a continuation pattern on an upside move. And we had one here, by the way. We had a little bit there in a falling wedge over there. And that was quite flag-like as well for an up leg. So, I know continuation is what we trade. And this is quite low volatility. This is what we call squeezing. That's on the monthly time frame. I'll take you into the weekly. And let me know if that's showing up nicely for your viewers to see. But this was supposed to be actually drifting off down on the debt because September cut and all of that. But what you're actually finding is that you've got quite a decent support here now, and you've just been bounced off that 4.25 level again. So it's struggling to get below this level. I still think there's a chance it does. We're going to have probably some bad economic numbers. That's the confusing part about hyper stagflation. You get job losses, you get low tax receipts, you get contracting GDP numbers, although remember the dollar's devalued a lot, so the real contraction, the nominal can be flat or even slightly up, but you can be contracting because there's much more inflation. But I still think there's a scope for a little dip down, but in the big time frame, this is up. And that, funnily enough, is the exact same view I have been giving on gold, because everyone's a little too excited about gold. As I mentioned on the YouTube channels, they've gone reval crazy. And I don't see them blowing up the banks on a derivative maelstrom of going 5x or 4x to 20,000, 15,000 or 150,000 for that matter. They might mark to market it, but even doing that, that gets us all looking at gold and buying gold. So I think the digital assets, the stable coin, is how they're going to sell debt going forward. And that's why there's an interesting opportunity potentially in the crypto markets and stable coin usage, which is now a buyer of debt. And I will highlight, and I remember to this day, Bitfinex was being continually harassed, was changing banking relationship all the time, was being chased down by the likes of the SEC and also the Tether, because there was a relationship overlap there with Tether and Bitfinex. And then suddenly there was a conversation that was had, and they announced that they would use treasuries as collateral for Tether. And you know what? All the harassment suddenly stopped. Isn't that funny like that? Isn't that really funny? And I said, that's it. That's going to be their scam. Now, that was quite a few years ago now. I think it was about 3-4 years ago, maybe even more. I was an account holder with Bitfinex, and it was always like secret squirrels just to send them some money. And now it's not a problem anymore. It's not a problem. So they've got a buyer for Tether, and if they increase the proliferation of Tether, they increase the purchase of collateral of debt. So they find a chimp in the room that does the not-for-profit trade and buys the financial repression asset that actually in capital market senses is going to go down in real terms and provide an insufficient yield as well during that time.
But what's the volume? What's the volume of buying on Tether? Is it enough to create any sort of
very low at the moment? It was about number 18. So this is still just a star in a bag for now. But it's certainly, if they go mainstream and he wants to sell debt, Besant's primary job is, how do I sell the worst product in the world, this excess proliferation of debt? How do I become a salesman for that? And if the people are going to get pumpermentals on the other side by buying into Tether, dumping their old world fiat, getting into Tether as an on-ramp, and when the markets in crypto aren't going up, getting back into Tether, that creates a far bigger Tether market cap that could start to become meaningful in terms of treasury holdings. Don't forget, Tether, if you'll allow me, I'll just show you the market cap. If it went up 10x in size, it would probably start reaching a few trillion. Let's just have a look at the stablecoin market for you by market cap. As you point out, not overly significant yet, but that's more than what China holds if you start to get to a trillion. So Tether at 165 billion.
Okay. Now,
it's not 100% backed also, but they might be pushed towards that direction. So if you get a 10x there, and Bitcoin's trading at 150,000, and Ethereum's gone up to double digits, 10, 13. We have a target of 14,000 this cycle for it, and you're getting a similar move in XRP and the other statist. And by the way, interesting parallel. Crypto and the status tokens, which are most of the top 10 and even into the top 15, is very much like a Mag 7. They just done model repeat. that are doing on the equity market side. So these things are going to become hyper-valued and are going to be bringing the new digital system. So all those that go chasing for penny stocks in the equivalent of in the crypto session, I'm saying it's like Apple in 2000. Buy the Apple shares. They sound expensive now, they get more expensive. Buy the Google shares. Be pragmatic. Some people say, well, Francis, why they're the enemy. Why are you doing that? It's going up without me, whether it does or doesn't. I'd rather be wealthy. You have to be pragmatic. I did not make Apple go up because I didn't buy their stock in the year 2000. You're getting a second chance now. XRP, XLM, some of these, they're all going to run. And I think it's going to transcend the normal cycle as well. We're on a more business cycle now. The actual issuance of Bitcoin change is almost immaterial now. We're getting into that more marginal element. So we're going to be business cycle. That ties in more with the NASDAQ, the liquidity, the M2, et cetera, et cetera. So it's funny how we're going to get a Mag 7 of crypto, which is probably going to be a Mag 15 in the same way as we have of stocks as a secondary point. But if that goes up 10x, and you're getting 15x on XRP and Ethereum and 3x more on Bitcoin, you're going to have a stable coin market. If I throw in USDC, which is at about 67, you've got about 200 and 60 and 60. You're going to be at about 220, 230 there billion. So a 10x, you start to get to 2.3 trillion. It's kind of helpful. I don't think it's not going to save us from hyperstagnation. It's just a great ruse to get quite a big buyer in. I think Japan's one of the biggest outside of the Fed itself. The UK, obviously the fastest climber at the moment, but Japan's at about 1 trillion. And the UK is almost getting to the point where it'll soon be overtaking China as the dumb money in the house, Cayman Islands and the others, in terms of foreign nations holding treasuries. So yeah, they're gonna boost. I think that's a plan, by the way. So it's something else for people to consider.
Does that imply that we stay in a growth-based environment? Because crypto's only gotten its run in growth. Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as the pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for Capital Cause and viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020.
Crypto, yes, typically. So that they could extend that cycle.
So we've been in a very low interest rate environment during the duration of crypto's time. It's never experienced a deflationary or a market where value is held over growth. Does that imply that growth stays in vogue?
I don't think you're getting real terms growth of anything nature. We're getting the final stage before admitting a full communist state. Governments are the biggest spenders generally, and becoming more so. The more immigrants they bring in, the more they entrench their role on welfare. That means they're giving even further money away. That's going on all over Europe. You've had your spell in the US, as you know. Supposedly it's slowed down and there's deportations. Look at the numbers that Biden let in and the amount that went out. You're in a far more compromised position. Those people are still there. They will still require it. You look at the bills, you look at the interest payments. Interest rates are not going down significantly and are significantly higher on more debt. So the interest bill is now higher than the military industrial complex, which got boosted by itself by the big, beautiful bill, which is by definition big and not so beautiful. So it's more pork pie for the corruption axis, which is the political, military, pharmaceutical, and all the attack vectors that are directed against the average human of society. So it's steel as usual. They've drawn out this war story. All you're getting is organ trade and massive amounts of money transfers to Ukraine and Israel. That's all you're getting out of all of this. And a very low tempo war that's largely lost. Long ago, they should have just closed this thing out. But it's like a vein in your arm where they get to suck blood from you. And they're not in any hurry to turn that inverse drip off. That's where we are. So there is no growth in proper, consistent, real terms in any major economies right now. For me,
growth in terms of growth stocks, right? So crypto really is pretty much correlated with NASDAQ. So if crypto continues to rise, should we also anticipate a similar move in the NASDAQ?
I think it's going to be nominally, the indices are going to continue to move higher. Again, I make the cautious point that it's in nominal terms and that in gold terms they have already reversed, and that in Swiss franc terms they haven't even made an all-time high, a new all-time high. They're still 3/4 of the way up out of the April crash. So you have to bear that in mind, that the dollar is losing value and has lost a considerable amount. A very quick share on that will help put that into perspective, because there's quite a lot of sympathy for a melt-up crowd. You've got to remember, if you do get, and a melt-up is both violent, and we're not truly seeing violence yet. Let's just say we take the NASDAQ composite here, which is probably the hardest charging. Many will go melt up. That's not actually a melt up. It's quite a steady climb. It has surpassed the previous high of the alts. But if you divide that now by, instead of the dollar terms, you divide it by the Swiss franc USD, you will see that actually you're yet to even fully retrace the April fall. And in fact, you were at an all-time high before that in January. You're yet to get back up there. That's in Swiss franc terms. Of course, I prefer, if you really want to counter for inflation, not the least bad of the fiats, but that which we just discussed, the 8.4 rate over 54 years for gold valuation. And if we divide by that, not only was January not a high, let's just go where we're going, Oanda, you'll see that in actual fact, you hit a NASDAQ high in 2021, and that actually, whilst you are in a rally, you are in a log step down. That is an A, B, and you can see that line there that got broken, C down. Yes, you are rallying, but you're nowhere near getting back to where you were. And the clear high for the NASDAQ was in fact in 2021. The tail end of 2021 over here. So that's what I would caution against. It's going to look nice, money go up, but gold is outperforming it, so money not going up. It doesn't help if inflation for you is actually 20%. To make 15, you need to make 21 just to go up 1%. And I would argue that the tech majors will continue to probably nominally go higher. There may also be sudden events that will take quite a lot of skim off them, but will broadly truck up. But it's a fool's trick, the nominal fool's trick, that gold is actually showing you how much it's underperforming in actual fact.
And speaking of gold, are we still looking at a pullback in gold anytime soon?
So when we spoke of gold, we said, yes, you are going to just not go up. It's progress decay. We're not calling for something like a 10 or 15% sell-off. We're just saying you're not going to be strong in any immediate moment straight away. You've got a couple of weeks of churn. And look at this right here. Let me take some of the drawings off. You've just had this PPI number come in and you're trading off down. So, I think you're going to probably remain in range here with possibly a bit more scope for a bit of downside and churn. We've said ourselves that if you break violently above the 3,440, sorry, it's that line there. we would get back in on the long side. So let me just remove that. And we gave our reasons. We gave technical reasons. We don't have the time to go too deep in that. But we showed also that apart from the 293K run, that most of the surge was kind of a little bit mini blow-off brought to you by the tariff tantrum. So once you'd run the 3,000 over here, you were having a natural pullback, and you got an extension because of geopolitical events. And since then, you've had that blow-off surge. It's kind of, you've run an extra 100 meters when you were doing a 1,600 event. So now there's a bit of a pause and a bit of a rest. And we've got this structure. And you've just had that PPI number. Higher rates are not good for gold, neither Bitcoin, by the way. And you're looking a little bit flat and you could sell off. So we just think it's not ready to break out. Once this rejection occurred and it went down like that, we looked to the monthly chart as we have done, and we showed that, and we show it again to you now, and just highlight that every time you're getting at 3.4, you are closing. This is a very interesting point, Danny. You'll like this one. That was the 3.5 high. You closed at 3.288. That there is 3.289. That is 3.303, and that is 3.290. So I'll just say that again. By the time you finished each month, but for one minor mini outlier, which was $15 away from the lowest one, you'd close to within $1 each time.
Wow.
So say it again: 3.288, 3.289, then not much more than $14 away, 3.303. And then closing back down here, 3.290. So you got three closes that were $1 apart. And I mean, let me just show that to you so people don't think I'm pulling their leg. So there we go. Just look at this number. Let's make sure everyone's with us and watching the right number there. We're looking at that number as I move the cursor around. So what's the number? The close. Whoops, not the low. My apologies. I circled the wrong box. Let's get the correct box there. I'm being stupid. The close. Again, let's watch it. So the close in April, 3.288. You see it? The close in May, 3.289. The close in June, 3.303, which is $15 away from the lowest number. And then the close in July, 3.290. So 88, 89, 90, and 03.
Is someone doing that on purpose? Is someone trying to keep the gold at like a very specific price level?
Well, what I can tell you is there's certainly rejection that was coming in. Then you had that rickshaw boy, and 50% of it was the rejection there. Then you have this doji candle, and it's mainly rejected on the high side. Then you have this shooting star candle, which is known to be at localized highs, which is why we're saying for a longer period than most expect, 3.5, which it just hit and was absolutely stopped right down there. Remember, at 3.5, because it was a couple of cents through 3.5, you're closer to 4K than you are to 3. So they didn't like that. And that blow off that Trump's tariff tantrums caused was most unwelcome. So you've traded up green the whole way in the first part of the month, and now we're already giving up some of that right now. And you've just had a PPI number, as we're just discussing this because it's just happened, and you're watching the fizzle back on that candle. So I can't tell you where it closed. I haven't got a glass ball, but what I can certainly say is that for one or other reason on this monthly time frame, there is a lot of selling in this box zone here. And you shouldn't ignore that at all. You shouldn't ignore that. So I'm concerned, and that is attempts to go higher that are reversed back down. That doesn't mean eventually you can't win in the end, but you might end up having a hammer first, which is the opposite candle at some point. That's been our view. So you get a
3,500. Is that the level? 3,500.
That's 3,500's up top there. That's on the dot there, yeah. But you may get something like that at some point before trading back up and have a little test. I don't think it's the end of the world. It's just everyone who's expecting It's amazing how the YouTube hype is an inverse rule sentiment indicator. I've never seen so many reval videos. Listen, if you had someone on who was talking about reval, it's no bad on you. If it's topical and has been spoken about, have it. But I'm kind of the anti-reval guys. They're not going to blow up the banks. All the derivative markets, by doing a 4 or 5x on the money just to open up overdraft that they'll end up consuming and then need to do again. They can't do it. The derivatives, it'll all be, unless they're ready to concede that, which I don't think they are. And remember, those banks have been doing the work for this cartel. You have to see it as a group of criminals in different departments. They're not going to, they're the shareholders of the Fed and the funders. And the banks are the funders of the political system. So no junior leader in the political system is going to bankrupt his boss. That's how I see it. So there's too much of this hopium. I want gold people to go back to being stoic, patient people. We're going to continue to get our rewards. This moon boyism is something I prefer to see just in crypto. I prefer it wasn't in crypto either, but the younger generation have their lessons to learn. But the smart old graybeards of precious metals stacking should get out of the notion of overnight sensations. We're not lottery ticket buyers here. We want to see this trade up through a price discovery mechanism and be unleashed. And you just had a major move from the 2000 level that took you right up to the 3, and then a blow-off surge to 3.5. And now you've got to rest a little bit. So don't expect too much. And so dollar, don't forget, on this interest rate story, might get a little bit of a bid. And in our YouTube video, we said, go have a look at gold Swiss franc, back again. So I'll show you this as well. You also met major targets on the Swiss franc. So we like to do 360-degree analysis. That's what we do. We try and see the valuations relative to many things. So that's the dollar for Swiss franc. You had a huge move. It made major targets. Let's show you those. There, a massive cluster of major targets. Targets are targets for a reason, because you're probably going to rest for a while. That's monthly. If we go back down to daily, we said on our YouTube channel that longer term, this red line breaks to the upside, but you're actually in a broadening structure that's tending to the downside. And you typically have 3 waves of selling. Flag, you can see it there. No real power to break out. Sell off, broadening structure. You can see it here. And now you've just had the bad news. I think you can get one more sell-off. We typically have waves of 3 sells, 1 wave of sell, 2 waves of sell, 3 waves of sell. But then the next time you come, everyone will be bored and say, gold's not making me rich, pumpamentals aren't coming. And then we'll be watching for a fractal here and a major breakout as a continuation pattern, even against the franc, which is slightly a better. By the way, the franc pays 0. The SMB's got a 0 rate. So all those arguments that get driven at gold that say gold doesn't pay interest. If you're in a semi-serious fiat, you don't get any interest. So gold is actually paying ahead of the Swiss franc for being a more serious asset and not paying a negative interest. And actually, if too much money leads America to get into francs, I think the next step will be the Swiss will actually charge foreign depositors in francs a negative rate to stop their currency from over appreciating. While gold will never do that. If you have a kilo of gold, in a year's time, you'll still have a kilo of gold. Nobody will nibble it for you. So that's what's happening on the franc. And then just to finish this troika of analysis, the dollar versus the franc. Generally, we're very bearish, the performance of the dollar against this, but we've just met an interim target. And that's also very interesting, which is why we think it will have a little bit of a short rally. And what's just happened? The news has just come on. PPI. It's amazing how technically we did this video long before this data. I was conscious that we were getting some CPI and some PPI this week, but I wasn't overly conscious of it. There it comes. You're getting a little bit of a move up on the dollar after making our second interim on a downside break. So the technical setup is that. Kind of goes like that. And we are expecting the 0.63 eventually to be run. But right now, you've had a little bit of a boost after running the second interim. And this is a month, but you were lower and you've traded a bit up now on that PPI news. I don't know how much further you go up, but maybe you do a mess around a little bit. as FX markets can. And then when we get to this period, Danny, where we spill, that's going to be not only very good for the Swiss franc and bad for the dollar, gold will be running again. So to everyone who thinks we're being bearish, gold will run again. It's just short term. I don't think you want to be leveraged long, and I wouldn't be chasing in with a massive lump sum. I'll try pick a relative low just to get more ounces. It's no doubt the trade, and the miners are catching up, by the way. I don't know if you want to hear about one miner that we covered today.
Yeah, go ahead. Was this Hecla?
Hecla, yes, that's your monthly setup. It's currently trading 7.64, and we say it's going to run 85. That's on, it's actually a quarterly setup. Sorry, I said monthly. Let me get it straight. Quarterly, 3 month. Now I want to show you a setup within a setup. So let's drop to the monthly time that I was talking about and why we were kind of excited about this one. It had what's the word? Earnings report today. So, or was it yesterday? My apologies. I might be talking out of turn. So it's squeezing not only on that bigger setup that I showed you on the 3 months, it had a squeeze. We call that a primer, where you squeeze within a squeeze. So this is the monthly view of a much bigger view that's now off there. That's only our third high and our third low, which is tight. And if I take you into the daily, so we're dropping down time frames here. You had the earnings. There was a lovely little fractal, and you were going into the earnings, and that was a gap up. If you waited for the earnings to buy, you ended up at best getting in there. You should have got in there. Beautiful little setup on that one, and I'll show you it. It's currently at a target. I wouldn't chase in here. I think once you've just had a gap, you should let it wait. So let's get that one right and draw it for you. There we go. Again, an upside HVF there. You just smashed that target of 772, and you would have got in on the close at 611. 611 to 772. You made yourself 160 cents, $1.60 on a $6 share. That's a 20% move in a quick move, and you can see it pulling back now. And that might have something also to do with the PPI. People will say, well, we've got a bit of an event. This is an accumulate on the longer time frame, however, and this is one of the values of HVF. We let this pull back. We keep adding to the portfolio. Had you bought it here, you would have got in real cheap. Then you are in a break for 85, and you would have a stop super tight at about 603, 604. So miners are starting to wake up, and that's definitely a good thing. Let's take you back up to that big setup, all the way back up, and there it is. Let's do it. Well, take that one off. That's it. 85. 85 is our expectation for this stock. Up there. That's quite some way away, 84.75. So there's quite a few miners that are well set up for quite big moves.
And Francis, is that because the oil price has been relatively subdued while the gold price has, vastly overtaken it?
100%. I feel it is that. Don't forget, you're talking to the guy that said a year ago, long gold, short oil if you want a commodity neutral trade. And that is wrecked consumer, low oil prices. Don't forget, we've got a hot war in Israel, or genocide, however you want to frame it. You've got a Ukraine-Russia war. You've got all of this, and you've got oil barely moving. That's a wrecked consumer. Less flying, less travel, less expenditure, less packaging, less ordering on Amazon, less a bunch of stuff. And you've got a collapse in the debt market and financial repressional times. Gold absolutely running. So the gold oil trade that we've discussed a few times with you actually made its target. Another reason, thank you for finishing my sentences for me, by the way, because this is the other reason why we are saying gold might have a rest for a bit, because you're just asking all the right questions.
And here's the other thing, Francis, I'll let you go through this, but if you chart the GDX on top of this, you'll see that, they're pretty much moving in tandem. That ratio as well as the GDX. Yes,
I'm pretty sure you're right. Let's just show you that trade. There you go. Another cluster of targets. So we said quite some time ago, it was in first half of July when we broke here, that, hey, guys, gold is going to go from 28 barrels an ounce of gold to more than double that, And you did. You made from 28 to 58. That's well through the 56 mark and took out both our targets that we had for that. That's a big overperformance for gold and an underperformance of oil. And some will say, well, why did you need a short the oil? Why didn't you just be long gold? Gold went up. Well, oil when at that date was $86. What's it now? Go have a look at oil. It's largely gone sideways. So many people thought, well, there was no alpha in the oil's half of that. Here's where you are on oil. You know, you're at July 24, you're up top here. Around, what was it? 83. And today you're at 63. It's $20 better. So it was, and it reduced the volatility of your trade and made you delta neutral, which people don't understand the value of that if they're new to trading. But it's an incredible, powerful thing, because if inflation is a thing, all things should be going up. Actually, we traded in an inflationary environment, but the stag part, stagnation, did damage to oil in spite of the inflation, whilst the reserve asset part of gold not only saw the inflation act on it, but the fact that it is the primary asset that preserves value that everybody is short of, overperformance on gold and relative underperformance and nominal underperformance in an inflationary environment of oil. And that's why you got alpha on both legs of that trade. And, you know, that's pretty cool, I think. So that's why we rest, because targets have been made. It doesn't mean it's a calamity. I'm looking forward to going leverage long again in a conservative fashion using HVF method, which is what we do. But right now, I'm just happy with my investment. And I think we go a little bit sideways, a little bit down, maybe a tiny bit up, but not too much, especially now this interest rates table has just been tipped over literally today with the data that we just had.
Yeah, well, it's been a fascinating talk, Simon. But before we cap things off, I want to ask you a question that I've been asking to most of my guests lately, and that is to wager a bet, not an actual bet, but give me your best thought out Black Swan event that no one else is talking about. Because by definition, a Black Swan event is something that's out of left field, something that's not in the zeitgeist, that's not on anyone's mind. If there's something out there that's not on anyone's radar screen, a big high impact event that's not on anyone's radar screen, what would that be in your view?
I'm smiling as you say high impact. Yes, I think you're also, I'm Simple Simon, also known as Francis, by the way. I think you're thinking of the other hunt there. The asteroid thing.
What about it?
They've already started seeded. When I hear Harvard, I hear a kook that has a high-paid lecturing job, but is actually an agent, identifies students for agents. I'm very suspicious. Sure, a lot of people go through Harvard that are quite innocent and get a fancy degree name, but they absolutely embed academia in there, which are part parcels working for various people. And there's currently a guy called Loeb, L-O-E-B, who is putting it out there that there is something with a trajectory in outer space hurtling towards our planet, and that it seems to be very well directed, which may imply alien control. So this is, for me, is absolute fantasia. It has a bigger stink than the original story of CV19 about it. It spells psyop by the person, by the university, and by everything else. And that is something that requires an entire planet to respond. Remember, they want to crush. The global communists wish to crush nation-state boundaries. That's what the EU did to start flattening out Europe and different laws that allow for a bit of arbitrage and different lifestyle. We could, like cockroach, slip in cracks that existed in differences in legal systems and approaches to various projects. You now get the leper colony and the leper colony rules, and everybody's got to kiss the chief leper to join. And what better a crisis could you have where we need all the resources of the world to fight this interplanetary threat? You know, it's such an ideal piece of BS that actually most people would know is BS. Well, I hope, but then again, we didn't overperform as sheeple against the you know what. So who knows? But they might magnify that one, and I think that's almost hysterical in its absolute absolute deception, but there will be plenty of people that will be bought in it, and they'll say, Francis, you can't say that. There are potentially other people that live in the world. Well, that in these times when we need a reset, that suddenly, for the first time ever, there's this well-documented, interplanetary, well-steered, attack vector. Sorry, I'm just a non-buyer, but that could be a real ridiculous out there moment. And then there's the other hoaxes that rhyme very much with ones we've recently experienced, which everybody knows. And I sincerely hope we don't revisit that again. But they truly want to have universal power over all resources in all countries. There's a ruling class that for which national boundaries now are a nuisance, and they have to coordinate operatives in all these countries to slowly flatten these boundaries and create a universal tax system, universal money, Bitcoin, blockchain, and all of these things being sold to you as saving you from your government means they are your new government, the Black Rocks and Vanguards of this world, as they ETF them, much like they ETF the Mag 7. So you should see the same serpent doing the same Shylock serpenty things. And, I'm always amazed by people's lack of ability to see it, but there's a certain kind of brain that functions in our way, and some see patterns and some can even score higher on IQ tests and cuddle up to their Stockholm Syndrome armed terrorist. But I'm not one of them.
Understood. I don't think anyone's talking about that right now, so that could very well be a potential black swan. Although they have been talking, they have been trying to see this Project Bluebeam thing, this fake alien invasion thing for decades now, stretching all the way back to Reagan with his speech about, at the United Nations. But
and nothing's for nothing. They love seeding a story. And look at before Icon Summit, there was some alien. What was that? Third dimensions of the third kind, or whatever. Who did that? Was it Kubrick's one? I don't know. But since that film, look at how much more spacey, sci-fi, futuristic-y alien stuff we've got. Star Wars became a genre. Then you get all of the stuff. Every third Netflixy guy is like this. So they do this nudge normalization of a concept through media for people to consume. So I watch their media very dispassionately and I go, what's the crook and the lie in all of this every time? So for me, it's like sitting a test to see how the liar is lying. Most people just go into alpha theta type relaxed zone where they're highly programmable and they just suck up whatever they're being fed. So they will buy the product, how it's packaged, quite convincingly, because they've all been inhaling the drug on their screen for quite a while. That's a sad fact. But
a lot of people who consume alt media do not consume normie media whatsoever, and I think that's a missed opportunity. Not because you're getting any real information from normie media, but it kind of gives you an understanding of what the average person is. You
can practice your analytical mind on the disinformation.
Yeah, so it kind of leaves you aloof if you're not aware of what all of these mockingbird media outlets are saying, because that's what the normie is consuming. That gives you a peek into the mind of your average person.
Absolutely. Anyway,
well, all right, my friend. Well, go ahead and tell us where we can find you and close things out.
Yes, YouTube, To Build Wealth, Trading HVF Method. We just showed you 3 time frames on Hector, how potentially utilizing a method, you could have been in something utilizing that method really early. By the way, the risk reward, Danny, on that tiny fractal just before the results, if you had the stop and the entry and you entered before, obviously, the news event, which would make sense, otherwise you're going to face a gap. If you stuck on that stop and it goes to 85, will be a 565 risk reward. So if you put $1,000 on that investment and got the maximum leverage on that, you'd be worth over $500,000 at the end. That's how we use technical patterns across timeframes to maximize your gains instead of just normal trading. The YouTube is the market sniper. Build wealth, help secure that wealth so that you hold on to it. And finally, the third point is get optionality to maintain a certain degree of freedoms in an ever flattening world with very little arbitrage between things. There's still opportunities to not get capital gains taxed out of all the wealth you make in a hyper stagflationary environment, which is going to give lots of opportunities to build wealth, by the way. And so it's not all dark. If you're talking about growing wealth, the market is going to be incredibly macro trendy, for which our particular method of continuations with low volatility setups, like that data release on the share, are going to be incredibly fertile. And it shouldn't be, oh, it's too much to invest. It should be, think about how much you're not making over the next 3-4 years in a booming, trending market without HVF method on your side. Taking those gold shares and everything else, cryptos, gold and silver, and many other things that we will be trading, including currencies, to the moon. Thanks for having me on.
For sure. Well, guys, if you enjoyed this podcast, drop us a like and comment "Go Francis Go" in the comment section. If you got value out of this, also subscribe to the channel so you don't miss another episode. And commenting, subscribing, liking the video certainly does go a long way in helping push this message and this video up in the algorithm. So a little bit certainly goes a long way. And let me know if you agreed or disagreed. I do, in fact, read all the comments. So drop me your thoughts down below, and check us out on Substack at capitalcosm.substack.com, where you can get early access, ad-free versions, and uncensored versions of all of my content for the YouTube audience. So with all that said, thanks for watching, guys. I'll catch you later.